Our next guest analyzes credit quality within the energy sector. Right now, he says bonds offer better value than stocks. He's Thaddeus Strobach from the Royal Bank of Scotland. We're also joined by our own Adam Johnson. But Thad, let's kick it off with you. You say it's all about risk versus reward.
Right, that's exactly right, Carol. When you're looking at the Sharpe ratio or other risk metrics, obviously a bond offers some compelling returns for a risk-adjusted reward. And specifically, stocks can offer great upside, but also more volatility often, and often a zero potential downside, whereas a bond, you have first claim on the assets ahead of the equity, so that if something does go wrong...
In most cases, as we've seen over the last couple of years, some questions
with the exception of the automakers, clearly, with the exception of the automakers, you do have first claim on the assets, and that's something that's key to emphasize when you're talking about bonds.
And of course, the dividend was cut for the stock. The coupons are still being paid on the bonds, right?
And obviously, cutting the dividend is almost always a credit positive when you're looking at something.
I have to, Thad and I have been friends for a number of years, and we have spent many a night in the bar talking about what this administration, how they deal with secured creditors in the Chrysler and the GM situation. I mean, doesn't it concern you at all, considering it's the same guys that sort of unilaterally changed the contracts on Chrysler bonds when you're dealing with BP?
I think there's an economic incentive to keep BP alive. You know, obviously, BP paying cash to clean up the Macondo disaster is more useful than a BP that is dead, and that's clearly the case here. So I think there is an economic incentive from all parties involved to realize that BP is a viable company and that it is more than able to handle even a crisis such as this, which is the most impressive thing about BP, is that its credit can handle this.
But the government involvement here that we've seen so far, which has been, I think you would say, tremendous, even if you don't want to use the word shakedown, clearly, that doesn't concern you at all as far as BP as an investment?
I think with BP bonds, it's a matter of will those bonds be paid off at par, and do they have an incentive to file for bankruptcy, and furthermore, does BP, you know, obviously there's different parts of the BP capital structure. You know, Adam and I have been talking about just looking at the different pieces of BP as well as Anadarko and Transocean. And
well, speaking of which, let's just take a look at a couple of the bonds, because as you're saying, risk creates opportunity, right? And if you look here, here's a sample of some of the bonds out there. Anadarko, Transocean, BP, all these bonds trading at 7.5. You liked them, I know, when they were trading lower. They were yielding 8.5, but they've rallied. Versus Conoco, 5.5, and a triple B average, 4.2. So which of these do you like?
Right now, we like Anadarko and Transocean. I think with BP, there's still a lot of risk volatility, even though it does have a higher credit rating of single A. When you look at BP, we're one hurricane away from dramatically changing the picture, whereas with Anadarko and Transocean, they're going to fall back on their contracts, their legal obligations, and what BP is legally obligated to do. You know, Anadarko, if you will, was a silent partner. They were not on the rig when the accident happened, and Transocean is going to be broadly indemnified from a standard IADC, or International Association of Drilling Contractors, contract, which is a lot like this agreement you sign with your contractor when he comes into your house to work on your house.
So
same thing.
Actually, Anadarko and rig bonds may be the buy then, right? If there's less liability, that's where the opportunity is versus BP.
Correct.
Thad, what about the prospect of, though, greater regulation of this industry in light of the BP accident down in the Gulf? Does that change in any way your outlook?
Yeah, absolutely. When you look at the operators who are very specific to the Gulf of Mexico, clearly there's going to be a short-term knock-on effect that would be negative, but that's been reflected to the most part in the bonds. The real opportunity is when you look at the oil service companies like Baker Hughes, Weatherford in specific, even Halliburton that has exposure.
There's going to be more business heading their way?
More business, but more importantly, the barriers to entry have obviously been raised in this business. So there may be additional costs, but the only ones who can incur those costs are the bigger companies. And the smaller players looking to get in the business will have greater difficulty. So the big will get stronger.
Well, let me, as a follow-up, do you see greater consolidation? I mean, there's been a fair amount already, but do you see some more consolidation as a result?
Yes, I do. Yeah, particularly in services. I think that you're going to see a lot of very strong companies that supply rigs with equipment, move the personnel, rotate them in and out with the helicopter crews.
Right.
Companies like Hornbeck were, you know, very strong credits, but have been tagged with this crisis, and at the end of the day, you're saying that those credits are going to be fine.
What about the big guys, though? I mean, BP, are they a target here? They've lost so much market value. Do we see huge chunks getting sold off? I think more likely is more huge chunks getting sold off, specifically their Russian assets as well as their Argentinian assets, and I think that would generate sufficient cash proceeds. But to be clear, I do not think BP is a takeover target because you're stepping in front of amorphous liabilities that you can't get a handle on.
And
Whether it's
we're
40
Nobody
million,
wants to,
50,
who wants to
60.
touch it, right?
Right.
Yeah.
Let me ask you about another possible overhang here. I did a story yesterday on the financing and the fact that BP might want to go out now and get some more financing because it's obviously looking at a lot of liabilities in the face. It has a $10.5 billion credit line that it hasn't really drawn down yet. Is there any concern that they'll want to do more, sell bonds? Is that a risk?
Well, clearly, but I think that if they do sell bonds in order to fund the escrow account, it will be at a longer duration. I think, Adam, we talked about, you're going to get up to it?
Yeah.
You look at, so Bloomberg function is just, you're going to type in the equity ticker, BP, equity, DDIS, and that'll give you the ladder of debt. And you can see that the bulk of the debt is coming due in the next few years. They really don't have a lot of debt that terms out. So if they were to come with a new deal in 2014 or a 15-year deal and term out this debt, then you can get a handle on it and start gradually paying it off rather than taking one upfront payment.
Gives them some time to play with.
Exactly.
Hey, Thad, we have to leave it there. Thank you so much.